What if I told you that one simple decision, made with the best intentions, could cost your children over $200,000? Not because of a bad investment, not because of a market crash, but because of when you pass down your home. Every year, millions of American families do what feels right. They sign the house over early, they want to help their kids. They want peace of mind, they want to avoid complications after they're gone, and without realizing it, they hand the IRS a massive check. Here's the uncomfortable truth. The difference between gifting your home while you're alive and letting your children inherit it after you pass can mean the difference between $0 in taxes and a life-changing tax bill. This isn't a loophole for the ultra-rich. This applies to normal families, normal homes, normal parents trying to do the right thing. So why don't more people know about this? And why is this mistake still happening every single day? In this video, I'm going to show you the exact tax rule that changes everything, and how one quiet decision can become the most valuable financial gift you ever leave behind. Stay with me, because this is something every homeowner needs to understand. Let's slow this down and talk about what actually goes through a homeowner's mind. For most parents, the house isn't just an asset. It's memories, stability, sacrifice. And eventually, it becomes a question. What's the best way to pass this on to my kids? This moment usually shows up around retirement. The mortgage is gone, the house is appreciated, and suddenly the home is worth far more than anyone expected. Sometimes 5, 10 times the original purchase price. At that point, homeowners face a quiet but critical fork in the road. Option 1. You transfer the house to your children while you're still alive. This feels generous. You get to see them benefit. You feel like you're helping them get ahead. And many people believe this avoids paperwork or complications later. Option 2. You keep the home in your name and let your children inherit it after you pass. This option feels uncomfortable for some people. It forces you to think about death. It feels less hands-on. And then on the surface, it doesn't look like it makes a big difference. But here's the problem. Most families make this decision emotionally, not financially. They ask, what feels right? Instead of asking, what does the tax code actually reward? And the tax code does not reward early generosity. In fact, when it comes to real estate, the IRS treats these two choices completely differently. Same house, same kids, same value, wildly different outcomes. One choice quietly protects your family's wealth. The other quietly transfers a large portion of it to the government. And unless you understand one specific tax rule, something most people have never been taught, you won't even realize the mistake until it's too late. That rule is what we're going to unpack next. To understand why this decision matters so much, we need to talk about one tax rule that quietly determines the outcome. Most people have never heard of it, yet it can decide whether your family keeps its wealth or gives a large portion of it away. It's called step-up in basis. Now, let's strip away the jargon and explain this in plain English. When you buy a home, the price you paid becomes your cost basis. If you purchased a house decades ago for $100,000, that number, $100,000, is your basis. When a home is sold, the government does not tax the full sale price. They tax the profit, also known as the capital gain. So if that same home is later sold for $300,000, the capital gain is $200,000. That gain is what gets taxed. So far, nothing complicated. Here's where everything changes. When a home is inherited after the owner passes away, the IRS resets the cost basis. The original purchase price no longer matters. Instead, the basis is stepped up to the fair market value at the time of death. Let's say the home is worth $300,000 when the owner dies. That amount becomes the new cost basis for the heirs. If the heirs then sell the home for $300,000, here's what happens. Sale price, $300,000. Cost basis, $300,000. Capital gain, zero, no profit, no capital gains tax. Decades of appreciation, sometimes worth hundreds of thousands of dollars, simply vanish for tax purposes. But here's the critical contrast. If that same home is given away while the owner is still alive, there is no step-up. The children inherit the original cost basis. So when they sell, the IRS treats the gain as if it all belongs to them. Same house, same value, completely different tax outcome. This is why timing matters more than generosity. The tax code doesn't reward good intentions. It rewards when the transfer happens. And once you understand this rule, the entire strategy becomes clear. Let's make this concrete, because real numbers make the lesson impossible to ignore. Imagine a homeowner named Linda. 30 years ago, Linda bought a modest home for $100,000. Back then, it was simply a place to live, raise a family, and build a life. No one was thinking about tax strategy. Fast forward to today, that same home is now worth $1 million. Linda has a son named Michael. Michael doesn't want to live in the house. If he receives it, he plans to sell it. So the question becomes critically important. When should Linda transfer the home? Let's walk through the first scenario. Linda decides to give Michael the house while she's still alive. The deed is transferred, the house is officially his. A few months later, Michael sells the home for $1 million. Here's how the IRS looks at it. Original purchase price, $100,000. Sale price, $1 million. Taxable capital gain, $900,000. At a 20% federal capital gains tax rate, Michael now owes $180,000 in taxes, before even considering state taxes. That's money that could have gone toward his family, his future, or his investments. Instead, it's gone. Now let's rewind the story. Linda keeps the home in her name and passes away years later. Michael inherits the property. At the time of her death, the house is still worth $1 million. Because of the step-up in basis, Michael's new cost basis becomes $1 million. He sells the home for $1 million. Sale price, $1 million. Basis, $1 million. Capital gain, 0. No capital gains tax, no six-figure surprise. Same house, same appreciation, one decision changed everything. Linda didn't alter the market. She didn't use a loophole. She simply understood timing. And that timing preserved nearly $200,000 for her son. That's the power of knowing how the rules actually work. At this point, the question becomes obvious. If the difference is so dramatic, if the rule is so powerful, why do so many families still get this wrong? The answer is simple and a little uncomfortable. Most people were never taught this. Step-up in basis isn't explained in school. It rarely comes up in casual financial conversations. And unless you've worked with a very proactive tax or estate professional, no one sits you down and says, hey, this decision could cost your kids 6 figures. Instead, families rely on instinct. And instinct says, give it now, help them while you're alive, make things simple. There's also a lot of bad advice floating around. Some people assume that giving the house early avoids taxes. Others think inheritance automatically creates a tax problem. And many confuse estate taxes with capital gains taxes. Two completely different systems with completely different rules. So parents act early, not realizing that the tax code actually rewards patience. Another reason this mistake is so common is emotional discomfort. Talking about death is hard. Planning for it feels negative. So people rush decisions just to avoid the conversation altogether. But here's the irony. Trying to make things easier emotionally can end up making things much harder financially for the people you care about most. And this mistake doesn't just affect primary homes. It happens with rental properties, it happens with vacation homes, it happens with family real estate that's been held for decades, properties that were bought cheaply, properties that appreciated massively, properties where the tax consequences are hidden. Until the moment of sale. By the time your children discover the mistake, there's no undo button. The IRS doesn't care that your intentions were good. They don't care that you were trying to help. They only look at the numbers. That's why understanding this now, before any paperwork is signed, is so critical. Because this isn't about gaming the system. It's about playing by the rules as they already exist. And once you understand those rules, the smarter path forward becomes very clear. That's exactly what we're going to talk about next. So now that you understand the rule, the next question is obvious. What's the smart way to do this? For most families, the answer is surprisingly simple. In the majority of cases, the most tax-efficient strategy is to keep the property in your name and allow your children to inherit it after you pass, rather than gifting it early. This single choice preserves the step-up in basis, and with it, potentially hundreds of thousands of dollars. But doing nothing isn't the same as doing nothing correctly. First, you need clear legal instructions. That usually means having a will, or even better for many families, a revocable living trust. A trust allows the property to pass directly to your heirs, often avoiding probate, the long, public, and expensive legal process that many families want to avoid. Second, understand the difference between estate taxes and capital gains taxes. Most people panic about estate taxes, but for the vast majority of Americans, they're irrelevant. Federal estate tax exemptions are extremely high. Most homes, even very valuable ones, fall well below that threshold. Capital gains taxes, on the other hand, affect millions of families every year. That's the real risk. Third, remember that this strategy isn't limited to primary residences. Rental properties, vacation homes, long-held family real estate, all of these benefit from step-up in basis. And if your goal is to help your children while you're still alive, there are smarter ways to do that. You can gift cash. You can help with education costs. You can support a down payment, on another home. Assets that don't carry massive hidden tax consequences. Finally, and this part matters, talk to professionals. A qualified tax advisor or estate planning attorney can look at your entire situation and confirm that this approach fits your goals. Every family is different, but the rules of the tax code are the same for everyone. This isn't about being clever, it's about being intentional. When you understand how the system works, you stop guessing and start making decisions that actually protect your family's future. And that brings us to the most important takeaway of all. When you zoom out, this really isn't a tax strategy. It's a legacy decision. The house you worked for, the equity you built over decades, the sacrifices you made along the way, all of that can either become a foundation for your children or a windfall for the IRS. And the difference often comes down to one quiet choice that most families never realize they're making. Passing a home early feels generous. Waiting feels passive. But the tax code rewards patience. For most homeowners, letting your children inherit property rather than gifting it while you're alive can be the most powerful financial gift you ever give them. Not because you gave them more, but because you allowed them to keep what was already theirs. Now, a quick and important disclaimer. This video is for education only. Tax laws are complex, and every family's situation is different. This is not legal or tax advice. Before making any decisions, you should always talk with a qualified tax professional or estate planning attorney who understands your full financial picture. That said, knowledge changes outcomes. So here's my question for you. Did you already know about Step Up in Basis before watching this video? Or is this something no one has ever explained to you before? Let me know in the comments. I read every single one. If you found this valuable, hit the like button. It helps this video reach other homeowners who might be one signature away from a very expensive mistake. And if you care about understanding money, taxes, and the hidden rules that shape your financial future, consider subscribing to the channel. We're here to cut through the noise, follow the data, and help you see the economy and your personal finances with clarity. Thanks for watching. I'll see you in the next video.